Good morning and welcome everyone to our Onyx African American Business Hub at the Valley Economic Alliance. Today's program, Know Your Numbers, is going to be an incredible benefit to business owners who are looking to really establish themselves financially and grow their companies into the future. I'm Sonia Blake. I'm President and CEO of the Valley Economic Alliance in Northern Los Angeles, and welcome everyone to our program. The Valley Economic Alliance is here to promote business development, job seeker development, and connection to job training, as well as job opportunities, to help tourists visit the Valley and help boost our economy, as well as to conduct urban revitalization, encouraging developers to put our land to the highest and best uses to help create jobs, develop better livelihoods for our residents, and create thriving neighborhoods that help us to grow and to thrive. So we're really super thrilled to have this series of webinars, particularly for Onyx, our African American Business Hub. As many of you may know, African American owned businesses are one of the fastest growing segments of the US economy. However, many of our Black owned businesses face unparalleled barriers to accessing capital and growing their companies. This has a broader impact on our economy when this growing segment is not able to get access to the resources that are needed, whether it be the capital itself, the know-how about how to get the capital and develop businesses in other ways, and connect with the contacts that can help them get what they need. So we've created our Onyx African American Business Hub to really come alongside Black-owned businesses in our region, and since we get to work remotely, everywhere, to help bolster our economy, strengthen these businesses, and help everyone to participate in our prosperous, sustainable, and equitable economy. So that's what we're about here today, and we're so thankful for our partners and our speakers. HSBC Bank is one of our sponsors for the Alliance in general and for our Onyx African American Business Hub series, and we're so thankful to have their expertise because they're real educators. So they're helping everyone to really understand how money works and how they can be of assistance in helping companies to grow. We've also partnered with the San Fernando Valley Business Journal, which is great at getting the word out. We're so thankful that we've reached out to thousands of African American business owners in our footprint, and we're very excited with many that have registered and many that we're going to be able to get this content to at a later date as well. And we're really thankful to our partner, the Black Women's Network, which really helped us to create the program and to get the word out as well. All of you should know, before we get into our program, all of you should know that we have a free business assistance program here at the Valley Economic Alliance. And this program provides business advisors who understand and help a company to understand their exact needs, and not only in the area of capital, which is an important part of our program, but also with regard to other types of business development services like human resources, recruiting employees, finding real estate to build your business, as well as accessing capital and doing marketing, growing your businesses. Any topics that could relate to increasing revenues, decreasing expenses, finding staff or real estate, and in general, just kind of being more profitable. So we'll have in the chat a link to enroll in that program if it's something you're interested about, or you can get more information at thevalley.net/assistance. This program is being recorded, as you know, and the replay and slides will be available on the same webpage where you signed up for the event. That link will be placed in the chat as well, so you'll have access to that. And we welcome you to come to future convenings. We have committees that get together and help look at the problems that businesses may be experiencing in our region and how to solve them. We welcome your input on an ongoing basis. We welcome you to continue networking with our Onyx Business Hub, either at our office for meetups or online for these convenings. And you can learn all about that at thevalley.net. So that said, I really want to get to our phenomenal speakers because we do have a great lineup that's going to help us to dig deep into these issues of knowing our numbers. So I want to introduce three speakers, and then they'll speak in turn. So first I want to introduce Marie Pedraza. Pedraza, Marie Pedraza. And she is Vice President and Senior Regional Community Development Manager at HSBC Bank. So Marie manages partnerships with nonprofit organizations serving low to moderate income households and communities whose mission includes the creation and preservation of affordable housing, for example, foreclosure prevention, personal financial education, technical assistance, and financing for entrepreneurs and small businesses. So we're really very happy that she's able to be with us and help us to really understand some of these financial literacy issues that are really important for businesses to know. Marie is very well trained in these topics. She's got a BA in political science from CUNY. And I forget what that stands for. College, College University, New York, CUNY in New York. And Marie was born in Bogota, Colombia, and speaks Spanish, by the way. So that's a wonderful fun fact about Marie. We have Sherman with us as well. Sherman Belle, Senior Business Relationship Manager at HSBC. And Sherman has been in this post since 2006. Very experienced in this space, previously held related roles in retail business, relationship management, as well as business banking specialists. Sherman has 20 years of banking experience, and he focuses on companies with annual sales between $5 and $50 million. So very knowledgeable about the lending space. Very excited to hear his expertise. And then we have Keisha Buchanan, Regional Manager with Community Development with HSBC. And Keisha handles a very large region, Florida, Mid-Atlantic, and West Coast. We're so happy to have her as our West Coast go-to gal. And she's been in banking for over 20 years and at HSBC for a total of 13. So definitely knows where to find what and can help us navigate our way. She is such a mentor to local entrepreneurs and an activator of the entrepreneurial ecosystem. And so she goes the extra mile to really help businesses understand the ins and outs of the topics they need to know about. So we're so thankful for that. And she's got a wonderful training, her bachelor's in organizational management. So she really brings that perspective to small business owners who need to understand how to build their businesses. So with that, I really want to get to the content, the great content, and our speakers that we're going to provide. So I'm going to invite Keisha to share your screen. And Marie, if you would go ahead and please share your comments with us, and then followed by Sherman and Keisha. Thank you so much, all of us, for being with us today.
Thank you so much, everyone, for joining us. I am actually based in New York City, so I covered the New York metro area, which covers New York City, boroughs up to Westchester and Buffalo, as well as New Jersey, and at one point Connecticut. You know, in terms of my background, I've spent not all, but much of my banking career in consumer lending. So consumer lending, whether it's personal loans, you know, credit cards, student loans, car loans, or mortgages, all sort of have the same thing in common, right? Which we're going to talk about today, and that's credit. So over the years, I've spent a lot of time in credit. Maybe get a little paranoid about my own credit from all the information that you pick up, but really sharing that information with both youth, children, adults, and really seniors as well, because seniors very often could really be very susceptible to credit circumstances. So we try to spend some time speaking with them as well, and hoping that they will be able to manage their credit better and be more mindful of it. Sherman, is Sherman going to say anything, or should I just get started with the presentation?
Oh no, get right started. Sherman will
get started. Okay, great.
Go
okay.
To, yep. Yes.
So, okay, got it. Okay, so we are going to talk about credit today, and really personal credit is very important for anything that you do. So even though you're on the track to either own or plan to own a business, your personal credit is going to be the foundation for being able to finance your business for many, many, many years, and maybe forever, until you become a conglomerate maybe at that point in time. So we are talking about credit, what it is, how to build it, how to manage it, why it's important for you to be mindful of what your credit report looks like, if you've never seen it, where to obtain it, and how the credit scores are put together, what goes into them, and how your actions do affect you. So your behavior in managing your money do affect whether those credit scores are lower, stay stable, or increase. There is a workbook that you'll be receiving at the end of the presentation, and it follows the presentation very closely, but of course provides a lot more detail. Next. Credit, very basic. When you are applying for credit, you are going to be entering into an agreement or into a contract with the creditors. Where the creditor is through a department store, through a bank, and through whether you're getting just a credit card or buying a house, you're agreeing to do certain things. And for the bank or the institution to feel comfortable with you, they're going to really look at your credit and payment history. That's how the trust and risk factor comes about. If we're comfortable that you have paid your bills on time, we can definitely trust that you will continue to do so, barring some unexpected circumstance. And so we're willing to take a risk on you. And the risk is really measured by the interest rate that you receive, by the amount of credit that you are extending. Of course, credit is paid over time, and it does have interest, and there are things that you can do to control the amount of interest that you pay back. But all those three components really identify the various characteristics, the three characteristics that credit has, and it's true whether it's business credit or personal credit. So how do you build credit? You build credit by borrowing. If you don't borrow, you're not going to build credit. You can create a payment history. Go to the next slide, Keisha. So you can create a payment history, and that's why we suggest that you pay all your bills on time. So there are bills listed here, such as your rent, for example, and your utilities, that don't make it into your credit report unless it's a negative issue of non-payment. But basically your mortgage, car loans, medical bills eventually do make into your credit, and we'll talk about those later. And of course, credit cards. So if you don't have any credit history at all, you will need to either hope that someone will allow you to be a co-signer. Maybe you can be an authorized user on somebody else's account. And those two relationships are different, meaning that if you are an authorized user, you benefit from somebody's credit, and you're now responsible for their bills. But even though you're using the credit card, if you're a co-signer, whether you're co-signing for somebody else or somebody else is co-signing for you, there is a 100% responsibility on the outstanding balances. So if the other person doesn't pay, whoever's left there, whether it's one person or two people, they are 100% responsible for the debt. And if you don't have any credit whatsoever, depending on the transaction, some creditors do allow you to provide, in essence, letters of reference. Let's say your landlord always paid the rent on time, so you will be able to provide. Some tips for paying on time: definitely consider using auto pay. If you do use auto pay, make sure that you check those accounts regularly. Sometimes there could be not a mispayment for the bank, but maybe you needed to have somebody else use your credit card, and you get into the habit of not looking at things because you feel it's being paid on time. So why do I need to look at this? Important to keep in mind that identity theft is an issue, and you should always check your auto pay accounts. If you are paying online, make sure you understand what the cutoff for the payment is. Sometimes it's 11:59, sometimes it's 2:30 in the afternoon. And when you pay after whatever the cutoff is, technically you're late. Technically, you could be charged a late payment fee. Doesn't usually happen unless it's consistently something that you're doing, but just be mindful of that. Certainly you can have alerts sent to your phone or to the calendar to remind yourself of when the payment is due. And definitely feel comfortable reaching out to the creditors if you're having an issue. Right now, very difficult economic situation for many people. It is important that you stay in touch with your creditors, move the payment dates, have a conversation about lowering the rates, and always stay in touch. It's appreciated from them, and I think it will make you feel better once you have a conversation. It is important that you borrow what's noted here as enough, but not too much. Pretty much the suggestion is that you stay at 30% of your available credit. So if you have a line of $1,000, you shouldn't use more than 30%. Very often, and maybe more so these days, people are at 100% of whatever the line is, because the credit card is being used to pay maybe more things that people used to in the past. So it is important that you have a plan, that you make a budget, that you decide how you're going to bring that balance down. Because in the balance, being close to your line, it's going to lower your credit score, but it's also going to cost you a lot more in interest. So it's kind of like a two-pronged issue: more interest, lower credit score if you keep that balance there for a long time. So it's important to manage your available credit, and to also over time try to use different types of credit, which we have revolving credit, we have installment credit, and both of those are require you to pay differently. So it's important for you to be able to manage both. It is also important to maintain an old account, because basically your credit history begins with the very first credit card that you receive. So that will be your oldest account. Because that is your first credit card, it is very likely that it's going to have a low line of credit, that is going to have a higher interest rate, simply because the creditor doesn't know you. So you might be considered, you're an unknown factor. Most likely it will treat you as high risk. And so that account, as it stays open over time, you may really stop using it. As you build the credit history, you'll switch to accounts that are more favorable to you. And so the initial creditor may not make a change. They might not lower the interest rate. They might not give you a higher credit line. So at some point, you may decide, well, it's time to close that account because it's useless. And it's not useless because that is the birth of your credit history. And if you close that account, you're in essence shortening your credit history, which is going to decrease your credit score, because now the next second account will be the beginning of that revenue. So it's important to keep it open. And one way in which to do that, it's very easy, is to just set up automatic payment for a relatively small bill that you have to pay in full every month. And by doing that, you'll pay the bill on time. You'll keep the account active, and obviously you won't pay any interest because you pay in the account in full. Next. As I mentioned earlier, it is important that you can show creditors in time that you can both manage an installment loan that usually has a higher payment with a set monthly payment over a set period of time, as well as a revolving line of credit where the payments change according to how much you use, and there's a minimum payment required, every month. So that's usually your credit card. And if you're looking for new credit, you really need to ask yourself, why? Am I looking at it because it's a much better transaction? Am I looking to consolidate? If I do consolidate, how am I going to stay within the plan? And usually when you consolidate, you're trying to get a lower rate. You're trying to put yourself in a better financial situation by just making one monthly payment. But what often happens with people is that they'll consolidate 5 credit cards. They now have 5 other credit cards out there with 0 balances. And at some point, they'll be using both their consolidated loan as well as the individual cards. And in time, will find themselves very likely in a worse situation than they started out with, simply because they lack discipline, and they see this now as an opportunity to take maybe a second vacation or do other things they couldn't do before because their credit availability is so much more. Keep in mind also that every time you open up an account for a perk, whether the perk is a discount or extra points or whatever, it's a one-time thing that you're doing. Every time you do open up an account, there will be an inquiry, and inquiries can either be soft or hard. So a hard inquiry, you request an account, you do an application, the creditor, or you give the creditor permission to actually look at the credit, they make a decision, you get or don't get a new card. That is a hard inquiry, which means that what actually has an impact on your credit score, and you will lose some points. The soft inquiry is a little bit different. So a soft inquiry is when you look at the credit for yourself, with an employer, as is allowed in many states and in some types of jobs. When the employer looks at your credit report, that will also be a soft inquiry. And if you get a pre-approved offer, that's also considered a soft inquiry, because it's usually done by a creditor that already knows you, that's looking to give you additional credit. It is really, really important that you look at your credit report and or your bank statements or your credit card statements to make sure that the billing is what you think it should be. You know, one, there are identity theft situations where somebody could successfully access your account and run some payment through it. So if you don't look at your statements regularly, you're not going to know. If you just rely on your, let's say your bank's, your credit card statement to tell you this is what your credit score is, you're seeing a number, but you're not seeing the detail. And the detail is important because that's where you're going to know if the right transactions were put through, if there are things happening there that you're not aware of. So looking at your credit report is important to do, and you should do it at least once a year, and we'll go over that in a little bit. Also make sure that you don't give your credit card to other people, that you don't share your PIN numbers with other people. And if you do happen to find an error, that you take care of it quickly, notify the creditor, and at some point you also need to notify the creditors. Next. If you have not accessed your credit report, there is a site called annualcreditreport.com where you can request the report from each of the 3 agencies. So you are entitled to 1 report per year from each of the agencies. Very easy. You go online, do a quick form. You can look at the report online right away. You can have it sent to you. And you can also call. You do have to identify yourself. They have to be comfortable that you are who you say you are before they give you access to the credit report. And make sure that you use the right side. And I see it's being put in the chat because there are a lot, usually it's a commonly used sort of language. And so there might be other sites that kind of look like that, but then when you go in, they're going to charge you a fee. And the report will not contain a credit score unless you order from Experian, which beginning last month is providing a credit score when they give you the report. So usually there's a fee for the report. It could be $23 or something for the 5 year for 5%. So there are 3 credit bureaus. They are called Experian, Equifax, and TransUnion. And it is important that you look at the credit report from each of the agencies. And we suggest that since you get 1 a year from each of the 3, you spread it out. So you look at the credit report, let's say for Experian in January, and then for Equifax in June or something like that, and then TransUnion, later on in the year. Not every creditor reports to every single agency. So if you, for example, have accounts with HSBC and you just run the TransUnion report, you're not going to see our accounts because we don't report to TransUnion. And likewise with other creditors. So it's good for you to look at each one because that is the only way that you're going to get the full picture of what what's in those reports. Yes. When you actually get the credit report, and this is just a portion of what you will see. So the initial information that you're going to see is your personal information, your name, your current address, social number, date of birth, employment. But when you get to the bottom half of this page, which you don't have a slide of, that's where you're actually going to see the account. So you'll see the name of the creditor, the date that the account was opened, the maximum, the credit line on each account, and also a breakdown of whether or not you made the payments on time. And it will tell us it was 30 days late on this month and this year, 60 days late, 90 days late, whatever the case may be. So late payments do reflect. And the credit report also shows other information about judgments and collection accounts, what is known as a public record. So it is easy to read. If you need assistance reading the credit report, you can contact GreenPath, you can contact us, you can contact Valley Economics, so we can certainly help you on that process. How long does the information stay on the report? Well, there are 3 categories, and it depends on the kind of information. So the late payments, collection accounts, unpaid child support, judgments, and Chapter 13 bankruptcies stay on for 7 years. One change that recently happened with regard to collection accounts in medical bills is that beginning in July 1st of 2022, if you have a medical collection account that was paid, that's been showing in your credit report, you can go back one, that's showing your credit report, it will be removed. Okay, and going forward, if there is a medical collection account, there's also going to be more time. So typically, after 6 months pass, it automatically, the medical collection goes into your credit report. Going forward, it's going to be a year. So you're going to have more time to address the issue before it actually makes on the credit report. And the reason why the current administration made that change is because so many people are impacted by medical billing issues, causing their credit scores to really kind of dive in a non-necessary way sometimes. Positive information like regular payments will stay on for 10 years, as does the Chapter 7 bankruptcy, and of course the IRS will never go away, so that will stay in place for 15 years. Next. So this graph is a summary of some of the things I mentioned earlier, and it actually just gives you a quick view of how each of those things impact your credit score. Between payment history, which is how well you pay your bills, and use of available credit, which is your utilization rate, how close you are to your available line of credit, 65% of your credit score is made up from just those two things. So these are the two most important components that you have to be mindful of. But we also look at the length of the credit history, and that's why you don't close your oldest account. And that makes up 15% of your credit score. Then the credit mix, combination of installment and revolving payments that you can make, that's 10%, and new credit. So the inquiries make up 10% of whatever your score is. Do keep in mind that the inquiries don't stay there forever. They tend to fall off about every 6 months, but they do impact your credit score, particularly if you're borderline. So if you're between a good credit score and an average credit score, and you have a lot of inquiries, it could put you into a lower category. So credit scores range between 300 and 850. Each of the agencies calculate the credit score a little bit different. So when we as bankers refer it as a FICO score, we're talking about a score that combines the information from Experian, TransUnion, and Equifax. So that's called a FICO credit score. A good credit score is around 720. But the good credit score also doesn't mean that if you don't have 720, you're not going to be able to finance something. There are some things to keep in mind. One, if there is collateral, so if you're buying a car, if you're buying a home, there is collateral, and so you will be able to get a pretty good rate, even if the credit score is not 700. On the other hand, for a credit card where there is no collateral whatsoever, you're going to start out maybe with an interest rate of 18%, 20%, whatever the maximum is that the state where you live allows, because it's an unknown. There's no collateral. We don't know how you're going to pay, so most likely you're going to have a higher interest rate. It is a snapshot in time, so that it changes every month, or so, depending on how quickly they adjust it. But in essence, the last 2 years have the greatest impact. So when you're going to apply for credit, make sure that you start preparing now. So if there are issues, you take care of them before you actually apply, so you can get the best pricing available. You may have to explain issues that happened prior to 2 years if they're significant. So if there was a bankruptcy, if there were a lot of late payments, you do need to provide an explanation. So be ready to have it, and know that you can get assistance from Valley Economics, from nonprofit organizations that can guide you through the process of really making the best case possible for yourself. Again, the scores do vary by agency because different creditors report to different agencies.
Marie, just a quick note that this is the 2-minute warning or so, 2 minutes or so.
Okay, so if there's an issue, you can definitely go to the Equifax site. At this site, you can actually also access the other 2 credit agencies, so you can make the report in one place for 3 agencies. It takes about 6 months for you to get a resolution, so you should stay on. Next. Okay, and this is kind of like a quick scenario of how credit scores do affect the cost of credit. So in this scenario, you have two people with different credit scores. One has a credit score of 588, the other one 780, buying a car. Basically, one is looking at an interest rate of 14%, the other one at an interest rate of 3.39. And it has an impact on how much higher the monthly payment is going to be, $248 more for the person with the lower credit report. But additionally, if they also have to get car insurance, and insurance companies also look at the credit score. So on the insurance side, Jack is going to pay 263, and Jordan is going to pay 117 for the basic reason that one is a higher risk than the other, and one, the trust level is pretty high for one person, not so high for the other person. So over a 5-year term, paying more than $14,480 simply because of the difference on the credit score. Next steps, definitely obtain your credit report if you haven't done so. Make sure you review it. Make sure you act quickly to resolve any inaccuracies, and be mindful that it doesn't matter how simple it is, even if your address is only slightly off, make sure it's correct. Try to create a plan to reduce your balances so that you can lower the utilization rate and also pay less interest, and review your score at least quarterly so that you can address any changes that are there, and also close any issues, including possible identity. We work very closely with GreenPath Financial Wellness. Here is their toll-free number. They'll be in the workbook as well. And they can help you better understand your credit score, help you resolve issues, help you write letters. If there are identity theft issues, they certainly walk you through the process. It's a free phone consultation, and it can be done in whatever language you are comfortable with, which is a really good plus. Next. Okay, so I think we're at the question stage. Q&A.
Wonderful, Marie. That was awesome information. Thank you so much. It's exciting to see how much power we have and for financial self-sufficiency, and how much we can do. We can pull our credit, we can know our credit, we can influence it by how much we use or don't use the credit, and building credit that way. So that was super helpful. I think what we'll do is we'll invite people to type questions in the chat for Marie to feel that way. And then at the end of the program, we can circle back with live Q&A after we've heard all of our speakers today. So at this time, we'd love to hear from Sherman, Belle, and Keisha Buchanan. Please feel free to share the next segment of our presentation today.
Absolutely. 1 second. All right.
While Keisha sets this up, I just want to say thank you for having me, everyone, and for being here today as well. And thank you for Sonia and team to allowing us to come over and have this discussion with you guys. So as Keisha brought up, what we're going to be discussing today is how business obtain credit. Keisha, next slide, please.
One moment, Sherman. Let me just
Sure.
set this right. Okay, I'll have it in a second. There we go. Thank you.
Okay. So as Marie eloquently spoke before, gave you some idea about credit in general, sort of what goes around credit and scoring and so forth, I'll sort of start on that same line as it relates to what's credit, right? So credit is just another wood for a loan. When a business enters into a credit agreement, you borrow money from another entity, and the entity is called a lender, right? And the business is using their credit. Now, businesses may seek credit for a variety of reasons: assisting with startup costs, purchasing new equipment, acquiring inventory, covering cash flow deficits, and building credit history. So I'll just kind of talk through some of these points here. When we talk about assisting with startup costs, a lot of the times, you need money to start your business. It's typically tough to get from a conventional bank lending as a startup. So there are options to doing that, but that's something that most folks need as they're starting the business up. Obviously, to purchase new equipment. Now, you have a business, depending on your business type, what you're doing, you may need a vehicle, you may need an oven, depending on if you have a bakery or if you have some sort of pastry shop or whatever it may be. These you need to purchase equipment, and obviously that's what you can need credit to do, just that. Acquiring inventory, of course, getting goods and so forth. You have a warehouse, you're basically selling sneakers, you're selling any sort of goods to a customer. Of course, you're going to need some credit. Some folks self-fund. It's preferable at initial start, but if not, you're going to need credit to get some inventory. And covering cash flow deficits. What that talks about is You may be in business and you sell sort of on credit, right? So you sell to customers, you may be a wholesaler selling to retailers, and they may not pay. You may have terms with these folks, and when these folks may have 30-60 day terms with them. Now in the meantime, while you're waiting to get paid from your customers, you have to run your business. You have to pay your staff, you have to make payroll, and whatever operating costs you may have. Those cash flow sort of deficits need to be funded typically by credit. And the last piece, building credit history, as Marie alluded before, that's very important as you move forward, especially as you grow your business. Building credit history, whether you start with a credit card, something small, and then go up into additional lines as you grow and get larger as an organization. Having credit and doing well with the credit you had initially is going to help you build that credit history. So next slide, please, Keisha. What criteria do lenders use when approving loan applications? So lenders are focused on applications' creditworthiness, of course, or the ability to repay and the amount they wish to borrow. Creditworthiness is evaluated by the 5 C's. So I'll speak a little bit about that. The first C we're talking about here is capacity. Now, what that means is you're basically, it's going to talk about your ability to repay the loan, right? And we look at the revenue based on what you're asking for. So you're asking for X amount. Does the revenue you actually make in the business, or anticipate you will make, be able to cover the loan or lending that you're asking for? Character, of course, that's refers to your history of delivering on financial commitments. Maria alluded to that in her presentation, where we talk about your credit history, how you've done in the past. That is a big measure for us as you move forward in terms of lending to. Any lender will look at what your history is before they actually give you money for the future. Next slide, please, Keisha. Collateral. So collateral includes assets belonging to you that the lender can seize if you default on your loan. So for example, if you want to say purchase a building, or you want to even buy equipment like we spoke about previously, that item, that equipment or asset you're purchasing will be the collateral. In other situations, you may be asked to pledge cash or even your current home, as it's basically giving the bank or the lender some sort of security that you have some skin in the game, right? So you're borrowing money not just unsecured, but you're actually putting something up of your own that is we're going to use as collateral to be able to lend you the loan, lend you funds. Capital is any funds that you've personally invested in your business and the value of business assets versus liabilities. Same sort of principle where you have skin in the game. You come into the bank to borrow money, but what are you bringing to the table? You're not just coming empty-handed. I want to borrow X amount of money from you guys, but this is what I've collected thus far. This is what my savings. This is what we, as my partnership, we've put together as our initial capital, and as such, we want to borrow money. And the bank looks at that favorably when they're looking to lend you money. Conditions. Conditions can cover external factors, such as the state of the industry and economy, as well as the purpose of the loan. So what that talks about is, for example, if we're in a bad economic time, or you're in an industry that is sort of declining, it's you're selling goods that are not necessarily really good, really going right now based on the economy, right? It's just a decline in that industry. It's going to be a tough sell to borrow money from any lender because your industry may be declining, or what you're proposing that you're trying to get money to borrow and to grow that business is not in line with what's actually happening outside. Just the economy overall. If things are looking bad, if things are looking glum, it's tough to borrow money. In good times, when things are looking up, everything is turning well in the economy, it's a better time. Typically, banks are more willing to acquiesce and lend you money. All right. What information might a lender use to determine creditworthiness? Keisha, you want to go down one slide, please? Thank you so much. Okay. So when you apply for a business loan, the lender requests information that can use to assess your creditworthiness. Different lenders will request different documentation, and some lenders require much more information than others. So the list on the left shows sort of some of the things that we, as a bank, will look at, or lender will look at when assessing your creditworthiness. Definitely a good business plan. If you're coming in and your business is not really established yet, especially a startup, you want to have a solid business plan in place. You want to be able to show the bank that you have something, you know what you're talking about, you know your industry, and you have something solid as it relates to what's ahead. Financial statements. Now, typically, what most banks or lenders look at is your tax returns. The challenge becomes now, if you're a startup, you may not have that, and that's where the business plan sort of may help with that in terms of what is expected, sort of what you will look at as your possibilities as you move forward. So the business plan will help illustrate that, But if you have a business that's established for typically 3 to 5 years, we're going to want to see the financial statements, tax returns, and so forth. Revenue and sales figures, same thing. Your personal credit report, as Marie mentioned, it is very important that you have good credit when applying for business, because that will determine, one, if you get the loan, and also the pricing of the loan, meaning what they charge in terms of interest rate. Now, a lot of times banks, lenders lend on what is called risk-based pricing. The higher your rates, the higher your credit score, the more credit worthy you are, and as such, you tend to get paid less interest, as she illustrated in the previous presentation. Business credit reports and score. Now, business credit report is something that's sort of shaky in the sense that you've never lent money before, you may not have a credit score on the business front. So that's why it's more important it's really important to have the very strong personal credit when you're looking to borrow money. Income tax returns, again, that ties into financial statements as well. Bank statements. Have you shown that you are solid financially already? You're coming on solid ground. What have you done so far in the business or personally, right? Do you come with a strong bank statement when you're looking to borrow money? The bank looks at all those things and tries to assess the risk that for the person that's asking them to borrow the money. Resumes for your business principle and resumes for you on business principles. Once again, what is your experience, right, in this line of business? Are you trying to sell shoes, but you are a mechanic, right? Are you trying to get into some sort of business that's totally out of scope? Those things tend to have red flags for lenders. If you have some experience, say you were working in a particular business before and now you're branching off on your own, that tends to fare out better than somebody changing industries. Not to say that you may not be able to get through, but again, it tells a better story when you have some experience, whether it be yourself or your partners, the folks involved in the business. List of assets can be used as collateral. As I mentioned before, collateral is important. Legal documentation, patents, leases, and so forth. If you have a particular product, for example, that been patented and there's good potential for that, that's what you'll be using to try to get your credit. Now, what is business credit score? As I mentioned before, lenders will probably both look at personal credit and your business credit score when evaluating your credit application. Your credit score provides lenders a rating that reflects creditworthiness. The higher the number, the more likely to pay back the loan. Speaks the character, right? If you're not paying your bills personally, you're not likely going to be paying back the business loan. And that's why it's important to have a really good personal credit score. As I mentioned before, the business credit score is a bit different, where if you've never borrowed money before as a business, that may be a little shaky, and the banks tend to have less reference on that, but typically we'll start with the we'll put more emphasis on your personal credit. Now, if you have been in business and do have a business credit score, of course, you want to make sure that it's as high as possible and you've been doing what you had to do as it relates to borrowing money and being, true to your debt. Next slide, please. Okay, where can I get credit? So banks and credit unions are traditional sources of small business loans, but they aren't the only lenders. Alternative lenders are becoming more mainstream and offer flexible credit options that fit needs for small business owners. Now, there are a number of other organizations beside the banks that, some fintechs out there, certain organizations that do just that. And it's a matter of doing research to try to figure out what the alternative lenders are. As I said, some alternative lenders include online lenders such as peer-to-peer, business-to-business lending. Both traditional lenders, alternative lenders have the advantages and disadvantages. So in that sense, where, a conventional lender, you can go to this brick and mortar place, at Chase, Citibank, HSBC, as for example, or any conventional bank, they have that reputation, they have that history, and most folks tend to be more reliable, more confident and comfortable with dealing with organizations like the banks, conventional banks. These other organizations have been around for lesser time, but they also provide services that you can get your credit if you need to. What should I look at when comparing loans? So you want to choose a lender and credit type that meets your funding needs. Is really important, right? Your research shouldn't end there. You should be sure to review the following credit terms before you sign on the dotted line. Next slide, please, Keisha. Other fees. So what this talks about is you may have lenders that may charge you, say, application fees. They may charge you hidden fees. So it's really important to, look at the information that's being presented when you make your application. Make sure you understand, read the fine print, if you will. Understand what you're getting into. All right. Be sure that when you're signing that document, you're comfortable with what you're signing. And sometimes we may be, we may not have a choice, but at least you want to go and make an informed decision and make sure you understand what you're signing. Interest rates. As you can see, the interest rates and credit vary greatly, right? From type to lender, rates go as low as 2.5% and as high as 100%. And 1% interest difference can save you thousands, $100,000, and can be, that's something you have to look at. Obviously, as I mentioned before, it may not be a choice that you have, right? When you're borrowing money because of your credit situation, probably financially not in order, your credit score is not that good. So you may have no choice but to go with the lender that provides you the money, but they will charge you excess interest. Yeah, that's why it's very important to have your ducks up in a row, try to be in a good financial position in advance of borrowing money or asking to borrow money, because that will definitely lead to you to getting a better interest rate. Again, it's based on risk, and your risk is typically assessed by your credit score and your payment history. So if you have that in place, you tend to get a better interest rate. Terms and restrictions. Review all the fine print and the contract and make sure you come to all the terms. You may have terms that you can negotiate out. For example, a bank may want to give you 5 years versus 10 for particular loans, or 3 versus 5, that type of thing. You want to look around, and if you can, shop around, right? And especially if you're in a good position with your credit score and your financials are solid, don't necessarily take the first offer. Look around, see if we can get a better deal, and just overall be vigilant around that to try to get the most appropriate terms for your business as you move forward. Next slide, please. Collateral. Secured loans require borrowers to pledge an asset collateral, which the lender can seize if you default on a loan. That's what we talked about before. Understand if you're pledging collateral, that is something that the bank can actually take. All right. If you don't honor the payments on the loan, you go into default. You're basically telling the bank, yes, Mr. Bank, you can have my property, you can have my equipment if I don't default on that. So be very mindful when you get into these type of contracts. Understand it is very important that you don't say bite off more than you can chew, and make sure you do right by servicing the loan as best as you can. Down payments. Some lenders require larger down payments than others. And so, you want to look at that as well when considering. Again, as I said before, shop around, do your due diligence with the lenders. This is your business, this is a long-term investment. When you're looking to borrow money, you don't necessarily want to go to first lender. Sometimes your hands are tied and you have no choice but to jump into a sort of a bad deal. But you definitely want to look around and make sure that you're getting the best sort of service and also the best sort of circumstance for yourself as you move forward with regard to down payments. Next slide, please. What should I know about interest? Even interest rates that seem to be low can end up costing the business a lot of money. That's why it's important to understand the different types of interest rates that are being calculated. The interest rates are as a percentage of the amount borrowed, and for the business is really compounded. While simple interest is calculated using only principal, compound interest is calculated using principal and outstanding interest. So this basically speaks for itself. Typically, when you borrow a loan, it is going to be compound interest, right? The bank is going to use what you have outstanding plus interest calculated on top of that. So it keeps on growing. So you always want to make sure, also when you're looking to borrow from the bank or any institution, ask them, is there prepayment penalty, right? Because if you're doing well, you might want to pay that loan off as fast as possible. That helps reduce the amount of interest as you go along. So keep that in mind as you move forward. How do I know how much I can borrow, right? Lenders will only borrow the amount they believe you're capable of repaying. Many use a formula called debt service coverage to determine the amount. Use the SCR up to applying they'll using the debt service coverage, right? What that actually talks about is, can I service the loan I'm asking for? So I'm asking for $100,000. Can I, when they do the calculation of the interest, does that come out to be they want a ratio of 1? So for example, if your interest is 10% on $100, right? That's $10. They want to make sure that you can actually show that you made the $10, and preferably you made actually $13.50, right? Is 1.35 of the amount. So the higher the debt service coverage that you can show based on your financials, that's why your financials have to be in line. A lot of folks, when they do their business tax returns, they tend to want to, I would say, hide money, if you will, or do sort of creative accounting to avoid paying taxes. But what that does, it doesn't look good on black and white or on paper, right? So when you bring that to the bank, yes, you are not paying taxes to the government, but at the same time, you're not looking good on paper as it relates to what you're asking for. You have to show the money, you have to eat the taxes, and you have to be able to show that you can pay the loan, if I'm making sense. Be mindful of that. Show what you need to show, have a discussion with your accountant, and ensure that your numbers line up and that they reflect that you can actually service the debt you're asking for. It's very important to keep that in mind. Okay. What if I'm having a hard time getting approved for credit? So there are many reasons why you may have trouble getting approved for a loan. For example, for new businesses, you may not have established credit or solid financial history, and you may lack enough documentation to convince a lender of your creditworthiness. You may even have low credit score due to some past financial mishaps. So this way, I'm going to have Keisha jump in and talk about the CDFIs, because conventional lending may not be most suitable for someone who's just starting, as I mentioned before. And organizations like the CDFIs, SBA, and even SCORE can help you sort of go along that line. Keisha.
Yeah, thank you. Thank you, Sherman. Great job. Yes, I just wanted to jump in and talk a little bit more about CDFIs, which are Community Development Financial Institutions. There are over 1,000 CDFIs operating nationally. Nationwide, and they are a collaborative force that brings like diverse lending, with whether it's private or public, from public investors, and they provide responsible and affordable lending. Like Valley, they also provide technical assistance, one-on-one counseling, things like that. So there are options, as Sherman indicated. I like to be extremely transparent, and I don't know if you're at last week's session where we talked about business plan. I like to be transparent. When it comes to a bank, you might not necessarily be able to, as a startup, to walk into a bank and get the funds you need. We typically like to see 2 years, unless there's a startup program. But CDFIs can help you. They can, they'll be able to get you to capital, review your circumstance, look at your projections, look at what you anticipate making, your history, your credit, things like that, and be able to provide the support. And the best thing, to see Valley Economic and have them direct you to a CDFI in your local market. So back to you, Sherman. Thank you.
Thank you, Keisha. Yes, so just to kind of review the key points, of obtaining business credit, there are lots of important factors, to think about when you go through the process of obtaining business credit. Here's some few tips to consider, right? Maintain strong financial records. As I mentioned before, make sure your finances are in order. Obviously, you go by the sales that you've had for the year, and hopefully we're all doing well, right? And we're having beautiful numbers. But once we get to that point, make sure that you have a nice discussion with your accountant, because if you're looking to grow your business and you're looking to borrow money, remember, keep in mind that it's not only about not paying taxes, but it's also about keeping good records, and also having something to show to the lender. You want to be able to show that you can service the debt, because you're now coming to somebody saying, I want to borrow money, I want to get X amount for me to do this project, for me to buy equipment, for me to do inventory and so forth. You need to be able to show the ability to pay that credit that you're asking for, to service that debt, if you will, right? To have that debt service coverage that reflects 1.0 or 1.35. All right, lead by example. Remember that your personal financial history may be considered when applying for credit. As I mentioned before, you have good solid credit. You can't just walk in the door necessarily with bad credit and expect to get lending. You may get it again from a non-conventional lender, but those rates are going to be astronomical. It's going to cost you a lot of money, as maybe illustrated previously. You have a bad credit, it leads to higher rates, it leads to much more output in terms of what you're spending over the cost of the loan. And don't give up, right? If a traditional lender does not approve your application, look into building your credit worthiness to reach out for support for small business organizations. What sort of Keisha mentioned before, the CDFIs can help you along that line. We ultimately want to have good credit and have best rates. But again, if for some reason it doesn't work out for you in that particular moment, don't give up, all right? Keep working at it. This is your business, this is your commitment, this is your baby. You want to make sure you do what you need to do personally and also with the business to build that credit up and to get that credit worthiness in order so you can actually get the best rates as you move forward and get lending as you move forward. Next slide, please.
Oh, thank you. That is it. I'm going to share our contact information, and then I'm going to turn it right on over to Sonia.
Thank you for your time, folks.
Wow, wonderful, Sherman and Marie and Keisha. That was so incredibly powerful. Very, very important information to have. So we looked at personal financial literacy, personal credit, and we looked at business credit in the two. So let's do some Q&A. By the way, everyone, we're doing something a little bit different now. If you complete, I'm going to put in the chat a link to complete our program evaluation. If you do that while we're still on the call here, you'll have a chance to win a $25 gift card. So feel free to do that while we do our Q&A for the next couple of minutes, and give us your valuable opinion. Your take on today's program and all of our programs really, really matter and help us to shape what we talk about in the future. So our three speakers were wonderful. And the burning question, let's see, I think that there were some questions in the chat that were already answered. So that's great. I think one of the questions was, how do we stop soft inquiries from happening in bank offers for credit cards from banks that don't have accounts? And I think Marie popped in the chat there that you can opt out at this one website, opt out pre-screen. Does anyone else want to share another thought about that soft inquiries by chance? Okay, I'm gonna go ahead and ask another question and we'll add to the mix. And if anyone has additional thoughts, feel free to use our chat. It's a great tool for that. For businesses, when a business owner decides that they want to have access to additional capital, do you recommend that he or she pursue a line of credit, a credit card, or a loan? Or is it purely based on the business owner's preference? If you could kind of distinguish between those three different types, a line of credit, a credit card, or a loan, how do we know which one kind of we want to go for?
All right, so I'll jump in on that.
Okay.
You want to talk? Sure.
No, go ahead. I can jump in right after with.
Yeah, so that's a very good question, and I think that's a lot of question a lot of folks have as related to the type of credit facility. Now, a credit card is unsecured credit. Now, typically you use that for, travel expenses, small purchases for the business typically, right? Now, that is usually the first step to getting credit as a business. If you're a startup, you're new, you don't have the financial history that we talked about, 3 to 5 years. Now you can apply for line of credit. Line of credits are typically used, and I say typically because there are the other uses, but to fund that gap we spoke about, right? So you're ordering goods, or you're selling goods to your customers at the wholesale or even as a retail, and you're getting credit terms to your customers. There is a gap where you're out of cash. You basically sent your inventory out, you've not gotten paid, you have a gap. You need to fund your business, able to pay your role, do your daily expenses. The line would typically cover that. That's a working capital line. Now we can get into trade lines and so forth. That gets a little more complicated, but typically that's what you use a line of credit for. It would also be used to even purchase more goods, right? You can say you want to buy, grow your business. You can have a line of credit to grow your business and buy additional inventory, but be mindful that it's over time that you pay. And some banks, again, like in case of HSBC, when you line of credit, there's a cleanup period where you have to cover the outstanding balance, typically within a 1 year period. Now, lines of credit are typically used as just to cover. You buy inventory, or you make payments, or you whatever it may be. Once you get paid for those goods that you've sold, you want to cover that line and leave that back to zero. So it's like a big credit card, typically, if you will, and typically with more favorable interest rates than the actual credit card. Now, in terms of the what do you call fixed lines, right? Or what am I looking for here? Keisha, help me out. If you want to make a purchase of equipment, installment loans, right? You will use that typically to buy equipment, because what happens is it's a reducing balance. So you want to buy a truck for the business. You're going to get yourself a fixed purchase line, fixed purchase a loan where you make that purchase, and over time, as the equipment sort of reduces in useful life, you pay it off, right? It's something that you get the money up front, so you're going to be paying right away. Unlike the lines of credit where you spend the money and you're paying interest monthly, in this particular case, you're going to be paying from upfront. So you buy a truck for $50,000, that's the principal. You can be paying down on that as you move forward, but you're paying over time with the useful life of the equipment. So I hope that answers the question. Keisha?
Yeah, what I wanted to jump in and just say, Sherman said it perfectly. It not necessarily is of what you want or just really a guess. It's actually the need. Do you need it for short term or do you need it for long term? And
right.
Once you decide if it's for short term, again, as Sherman said, for inventory, you would go with a line of credit that would more fit. And if it's for long term, say equipment over certain period, real estate, if you want to buy, a commercial property or whatever the case is,
right.
That's it depends on what the exact need, what you need is for.
Yeah, the need has to match the facility.
That's great. Now, another quick question before we hop off, and it's this, you hear all the time online, there's such a thing as predatory lending. And we got to be very careful of that. And you have to really research the signs of predatory lending and then know that you're going with a reputable lender. But, there's this other movement that you see online, these consultants that for a fee will help you build business credit. And they start, and it's business credit separate from your social security number. It's on an employer ID number. That's a real legitimate thing through the federal government. But these consultants say they can start you off with like store credit cards at Home Depot, and then you work your way up, and it's not connected to your personal credit. And you can work up to like hundreds of thousands of dollars of business credit that you don't have to give a personal guarantee for. Are those for real? Are those scams? Are those reputable? What's your take on that whole phenomenon?
I can start with that and Sherman will jump in. I say every time, I mean, and Sherman can attest, you know, as a previous business banker and his role, no matter, you could be, you know, $10 million in revenue, we always need a personal guarantor. It won't show, say you get a business credit card, it won't show on your personal credit, but this is why we do the personal credit piece first, because you will always need a guarantor. Someone has to put their name behind, you know, their stake in the ground and their name behind this lending. So if someone approaches you and say, you don't have to be a guarantor, or we don't pull your credit, or we don't look at yours, that's where you're wary. Now, if they say that, you know, it won't report to your personal, that's correct. Because if, you know, any business owner out there, you see, you know, that's the whole point of having business credit. So you don't commingle. Right. And Sherman, you can keep me honest here.
Yeah, I mean, Keisha is right. It's there are two pieces to it. We will always ask, or most banks always ask for personal guarantee, because we want to make sure you have skin in the game. As it relates to the business credit piece, again, I've heard these stories, I've heard about these organizations. I can't speak too much to them because I don't understand the inner workings of it. I would say just be very careful, be mindful of what is being offered, read the fine print, understand what you're getting into, basically, because that is very important. We don't necessarily report those things on your business loans on your personal credit. That's why you have a entity set up as a business LLC, whatever we do, would have that separation. But when something sounds too good to be true, it usually is. So just be very mindful and do the research and before you actually make any commitments.
Yeah, I just like to add something to that. And we talked about using CDFIs and community development financial institutions. I mean, you already work with a nonprofit organization. A CDFI will most likely give you advice and money without the same or lower fees, if even any fees, than some consultant that you don't know, that you Googled and, you know, their name popped up. And they could disappear. There's really no way to check people like that. But CDFIs and CDCs, community development corporations, are certified agencies. They work with banks. So, you know, it's a more legit place where you can get more than just money. You know, you get training, you get connections, you get classes like this. So it's more than just that loan. And if at some point in time there's a trouble with your loan, you're going to have a friendlier ear with a CDFI or a bank than you are with a consultant somewhere.
Fantastic. That's such great information. Well, I want to thank all of you, all of our wonderful speakers today, Marie and Sherman and Keisha. Fantastic wealth of information. And all this information is going to be, the replay is going to be available on our website. That info is in the chat. Thanks you all. Thanks you all so much for coming today. All of our participants, definitely fill out the evaluation, help us understand what other topics you're interested in learning more about. And we just really want to encourage you to enroll in our business assistance program if you need any help navigating this kind of space. Thank you so much, all of our speakers in HSBC. We will see you at the next program next Tuesday on influencer marketing and procurement contracting. So join us for that. Until then, be well. Have a great week. We'll see you then.
Thank you, everyone. Take care. Bye-bye.
Take care. Have a great week.
Bye-bye.